guidance, leadership, and support of Ralph Allen, Keith Albritton, and their fantastic team, this event would not be possible. At this time, I would like to invite Ira Anderson, chairman of the Lakeland Economic Development Council, to offer invocation. Ira is a partner with Caldwell Horowitz, LLP. Ira?
Thanks, Tim. Please pray with me. Heavenly Father, as we gather this morning, we want to start by saying thanks. Thank you for the gift of today and for your promise to always be with us. Thank you for this food. May it give us strength and energy for the opportunities and responsibilities that lie before us. We praise you faithfully for providing all we need in every way. Thank you for the county and city officials who lead Lakeland and our entire community to grow and prosper. Please guide their decisions and give them clear direction. Also, thank you for those who heed the call into military service and the families that support them. For without them, we would not enjoy the freedoms that we so cherish. Father, in your grace, continue to bless our families, our businesses, our community, and may we live all of our life for your glory. In your name, in the name of Jesus Christ, my Savior, we pray. Amen.
Thank you, Ira. Allen & Company of Florida, Inc. is Florida's oldest investment firm. It was founded by J. Everett Allen in 1932. The company has been a strong corporate leader for our community for more than 82 years. Keith Albritton, the president and CEO of Allen & Company, joined the firm in 1996 and has earned a CFP certification in 2001. In 2007, Keith accepted a position for president of Allen & Company, and 2 years later was named the CEO. Keith lends his talents to numerous organizations within the community throughout current and previous board positions. Under his leadership, Allen & Company continues to strive for excellence within the wealth management industry. Ladies and gentlemen, please welcoming Keith Albritton to the podium to begin our program. Thank you, Keith.
Thank you, Tim, and thank you, Ira, for that invocation. Welcome again, as Tim has already said, to the 27th Annual Economic Forecast Breakfast. They seem to come and go a little bit quicker as I've been around 18 years now, almost at the firm. I don't know about the rest of you, but they come and go quick. Couple of quick announcements here. Today we have kind of behind the scenes for Allen & Company, Robin Chaddock and Paul Weaver, who are here at the front table with our firm. I'd like to give them a round of applause for their hard work from our firm to get today's program to where it is. Thank you. Kathleen Munson and her staff at the Chamber are so very helpful as we work in conjunction to get this event planned and off the ground every year. So thank you, Kathleen, and the entire staff of the Chamber. We appreciate all that you do. It's been our privilege and an honor to sponsor the event all these years, 27 years now. At one common element between last year and this year has been our chairman, Ralph Allen, and so we had a unique celebration this past June. I want to take 1 second to bring y'all up to speed. Ralph celebrated his 50th anniversary with Allen & Company on June 1st of this past year, and many of you who know him know he's a star, right? He's a superstar, so we figured we had to do something that would be unique. So we called Switzerland, and we went through the process, and we literally named a star in the heavens, the Ralph Allen Star. So when you're gazing up into the heavens as the years come by, his legacy will be staring at you with the Ralph Allen Star. But Ralph, thank you for 50 years at our firm. Joanne is with him here today as well. He's going strong. So I'm in negotiations for another 20. I think I can get 20 more out of him. He's healthy as he's been, so thank you for your hard work. I want to thank all of our other associates who are here as well. We've got probably at least half of our folks here, so they'll be skedaddling back to get back when the market opens at 9. But thank you for the hard work you do and the invitations to get many of your clients here today, and we appreciate your leadership for your clients. So thank you to all of our associates who are here as well. What a year, huh? A good year, a calm year. I mean, boy, the last 4 or 5 have had some volatility, but last year had lots of volatility with it. But from the investing side, it was all on the upside. From the news side, it was all on the downside, right? I mean, so there's nothing but bad news all year. yet this economy continues to chip away. So we're looking forward to the predictions and prognostications from both Brian and Tony, who have been very accurate. I go to the tape every year, and I hold their feet to the fire on behalf of all of us of what did they say and what has happened. And boy, the last 4 or 5 years, both have been very, very accurate in their trends, and that's what we're trying to get, right, is the trend. I mean, nobody can nail it. People will have errors in their forecast, but both of them have been excellent. So what our purpose and our vision is that you as business leaders, organizational leaders throughout the industries that you're in, the organizations that you take part in, would have better information this year to make decisions, to make organizational moves, to invest your money, to invest your capital if you're a business, or to decide to expand or not. That's what today's purpose is that you would be able, better equipped. It's part of all of the reading that you might do. So we'll trust that that's going to happen today as well. And so it's my privilege to make the introduction for our first speaker, Dr. Tony Villamil. He's got a couple of pages of accolades here. So Tony Villamil is nationally recognized economist with over 35 years of as a successful business economist, university educator, and high-level policymaker for both federal and state governments. He was appointed by President George H.W. Bush as U.S. Undersecretary of Commerce for Economic Affairs, receiving full U.S. Senate confirmation of the presidential appointment. Tony is the founder and principal of a successful economic consulting practice, the Washington Economics Group, a Florida-based firm established in 1993 upon his return to the state from his public service in Washington, D.C. Dr. Villamil is the immediate past chairman of the Governor's Council of Economic Advisors of Florida, and during 1999-2000, he was selected by then Governor Bush as the first director for tourism, trade, and economic development. Presently, he's on the board of directors of the Spanish Broadcasting System, Mercantile Commerce Bank, and Pan American Life Insurance Group. He was most recently appointed by the U.S. Secretary of Commerce to serve the Florida District Export Council. Among other professional and civic leadership positions, Tony was selected in 2008 as the founding dean of the School of Business of St. Thomas, and he successfully ended 5 years and retired this year from that position, and he's now a recovering academic, he says, and so congratulations on that service, Tony. Tony earned his bachelor's and a master's degree in economics from Louisiana State University. He completed coursework for his PhD degree, of which he received in 1991 from Florida International University. Dr. Villamil is a resident of Coral Gables, Florida, and we have the unique privilege of having his wife, Mary Elena, and his youngest son, Tony Jr., TJ, here with us this morning. So thank you all for being here, and please give a warm welcome to Dr. Tony Villamil.
Thank you, Keith, and good morning, Lakeland. How are you? All of you, I appreciate very much the opportunity again to speak today and be here with Allen and Company and the Lakeland Area Chamber of Commerce. What a terrific leadership you provide to our state in terms of business climate, and of course, Allen and Company in terms of the oldest investment banking firm in Florida too. And Keith, I didn't know you were taping us. I got to be more careful now. No, I'm just kidding. But basically, the first axiom of forecasting is if you forecast often. So we need to do this every quarter then, not every once a year. But anyway, thank you, and of course being here with Brian and his tremendous insights into the financial markets and the equity markets and the U.S. economy. I have it easy. I'm talking about Florida. And I remember, Keith, last year we said 13 will be a good year for our state and our economy, and we're in the process of rapid recovery and moving in the right direction. And indeed, some of the numbers that we have show that we have actually exceeded that. The state of Florida is again one of the leaders in the nation in terms of payroll employment growth and GDP growth. And we'll talk about that a little bit. But basically, the summary that I had was that we have a steadily improving economic environment. And as a result of that, we should have a good business climate for us this year again, especially in the Lakeland area, which I mean by that, Lakeland, Winter Haven, MSA, or Polk County, in the I-4 technology corridor. If you look at, from a framework point of view, and I always do this every year, there are a number of drivers of the economy of Florida and specifically Lakeland that are important to us. On top of it, of course, is what happens to the U.S. economy is very important to the state of Florida in terms of bringing in people to come into our state, in terms of being able to produce and sell our goods and services to the rest of the nation. So things like interest rates and liquidity and economic activity and so forth are very important to the state of Florida. And when the U.S. goes into a deep recession or a great recession like we had, obviously our state, being a growth state, is impacted more than proportionally than other states that are more kind of like steady type states. So as the U.S. economy grows, like it has been growing in the last couple of years, even though I call it the underachieving economy because we could be doing better if it were because of some of the policies emanating out of Washington, we certainly are in a right growth path relative to the Florida economy, with the U.S. being critical. The global economy is also very important. And here in the I-4, we see more and more foreign investment coming in, international tourists coming into Lakeland. So the global economy is also a major driver of Florida and the Lakeland area. And then the business climate of the state and the business climate here in Lakeland is critical in terms of overall economic activity. And finally, on the left, I have what I like to call the long-term fundamentals, the structural composition of our economy, where we are in terms of the location of Lakeland as a center for not only logistics, but also now increasingly tourism and high technology and education and so forth. So those are the major components that we'll be looking at today. And if you look at the major components, and if you look at this slide and you want to keep having coffee and relaxing, you can do it, because this is kind of the summary one we'll talk about, unless you like statistics, which we will provide, Brian and I, as we go through. I don't want to give you a case, what I call my eyes glaze over, MIGO, which is an economist disease that we provide. But anyway, the U.S. economy, in terms of the framework, the U.S. economy, again, an underachieving economy, just plodding along. We are certainly doing better than many of the industrial countries that are in the world, so why not? We grew around 2%, 13, probably 2.5%, 3% this year. Somewhere, that's what the consensus forecast is. So the economy is moving along at a moderate pace, and that's important to us. That's important for Lakeland. The global economy, the Eurosclerosis seems to be over a little bit. The Eurozone, led by Germany, it has tremendous policies. I wish we had them here. Led by Germany, is really leading the whole Eurozone into a recovery. They had negative growth last year in the Eurozone, and this year they'll probably have positive growth. Everybody's applauding because it'll be a little less than 1%. I don't call that a lot of growth, but at least they come out of the downturn and they're moving up. So that's positive too. Our major markets in Latin America, the emerging markets, are doing well. Most of them in Latin America, in the Caribbean, and in other areas like in Asia, for example, with China looking at Florida increasingly to put in investment and to do trade and other kinds of activities. So, and then the Florida business climate is second to none. We have one of the best business climates in the nation. We have a stable fiscal situation in Florida. All of that is important to our state. Governor Scott has really taken the leadership role in attracting new industries, working with Enterprise Florida, and we have a welcome mat, and we do here in Lakeland, of course, for investors all over the world and in the U.S. So that's kind of like a summary perspective. Now I'll give you a little bit of case of MIGO, my eyes glaze over, polite company here, but we'll talk a little bit about the U.S., and I'll let Brian talk more about that. Obviously, that's one of his key areas of expertise. And this year, what I did is I put 2009, it's kind of like a background, so you see how big a downturn we had in the economy at the national level, and even more in Florida, and we'll talk about Florida in a second. You can see that our economy really had a great recession, as we call it, a huge drop in gross domestic product in real terms. And since then, we have been kind of plodding along in terms of subpar growth. This economy should be growing at 3.5%, 4% a year. We're growing less than that. Some say it's Washington policy, some say it's other things, but I tend to blame Washington more than Brian. But anyway, maybe that's Washington Economics Group because of my experience there. But as you can see, we're likely to have 2.5–3% growth this year, which is not bad. Certainly for Florida, given our good business climate and the population that is growing here, that's very important for us here in the Lakeland area. So against the U.S. economy and the dysfunctionality of Washington this year being a midterm election year, I don't think we're going to see a lot of craziness coming out of there. We have a truce in the war on the fiscal side, so hopefully that'll be over and we can continue growing at a stronger pace. The global economy, as you see, 4% growth in global output, according to the International Monetary Fund, and that's positive for Florida. The global economy, again, usually in a good year, in typical upturns of a cycle, growth around 5 to 6%. So 4% is nothing to write home about, but at least it's growth, and a lot of it is coming in from major trade partners of the state of Florida. So that's positive for us. So the global economy, again, and some of the opportunities in emerging markets relative to exports and investments will be there, and Brian will discuss that in greater detail. So if you look then at U.S. and global, it certainly is positive. And then what does it mean for our sunshine state, which is emanating sunshine again? You have heard that before. The state of Florida is certainly leading the nation in many of its own activities. One is, in terms of economic activity, one is population growth. Whether it's 1.3% or 1.5%, certainly population is growing. Again, people are coming to Florida, early retirees, people coming in with investment, foreign investment, domestic investment. They want to come to our state. I always say to my colleagues, economists outside of Florida, I say in Spanish, viva Illinois, viva New York, viva California, because there's quite a difference between those states and the state of Florida, so they all want to come here. So we are benefiting from the good growth in population, and that drives retail sales, retail banking, and all the activities that we're doing very well here in the Lakeland area. So keep at it in Illinois, Chicago, Brian. I love that for Florida's perspective. The GDP of Florida, again, stronger than the nation. We're likely to see around 4–4.5% growth. But look at the hole we dug in 2009. And again, because Florida is more sensitive to U.S. and global economic conditions, when you had a deep global recession, including the U.S., then obviously Florida, in terms of being a transaction-driven, investment-driven, population-driven economy, does worse than the average for the nation. So a big decline in GDP, but now we're growing and we're leading, together with Texas and other good policy states, we're leading the nation in GDP growth, and we're likely to do the same in 2014, this year. Payroll employment, it's showing some signs of significant improvement. We still do not have recovered all the employment level that we reached in the peak of 2007, because if we look at the huge decline in Florida's payroll employment. But we're moving in the right direction. Certainly 2.5% growth in payroll employment is pretty strong, even relative to the nation. And it's about what Florida grows in terms of payroll, 2.5–3% a year on the upside of a cycle. So we have reached a point now where we're beginning to really make some dent in issues regarding unemployment, and the state payrolls are increasing in many areas of the economy. Taxable sales is something that we follow closely. We tax everything that moves in terms of goods. And now we're making some reforms in Tallahassee, but overall, taxable sales is a good indicator of what's going on at the state and here in the Lakeland area. And I'll finish with Lakeland, but you can see that being a transaction-driven economy, you can see the big drop we had in taxable sales during the so-called Great Recession, and how we have started to recover at a stronger pace. And it's broadly diversified, all types of building investment, business investment, durable goods sales, and it's throughout the state. So we're starting to see the significant recovery in taxable sales, and we're starting to reach now the levels that we had back in '07. So again, the direction is very positive for our state. Okay, what does that all mean for our area here in Lakeland? Again, looking at it in terms of positioning and the momentum, and we do see, if you look at payroll employment growth, I like to look at payroll employment because statistically speaking, the samples of unemployment at the local area have a high level of volatility. So unfortunately, sometimes the press gets the unemployment rate and they blow it up. But no, it's not really payroll employment has a much better confidence level that you can see what's growing and not growing. And we're starting to pick up again in payroll employment here in the Lakeland area. The momentum started a couple of years ago. It intensified last year, 13, and this year we expect even a better year. So this data is November to November. You can see some of the changes in terms of payroll employment. And what I like is the fact that it's now in Lakeland is becoming more diversified. It's not just one sector or one industry, but the growth in employment now is starting to pick up in many industries here in our region. The next table shows the taxable sales growth, again, a major indicator in terms of spending in the Lakeland area or Polk County. And you can see how sensitive, because of wholesale trade and retail trade, and where we're located here as a center of the state relative to our major markets, how sensitive we are to the downturns in an economy. You can see the huge decline during the recession in taxable sales, and how since then we have started to strongly recover. The peak was about $8 billion in taxable sales in Lakeland, and we're almost there now in terms of the growth rate. So we're recovering and recovering very fast. And I think by the end of 2014, Keith, you can put that in the tape. By the end of 2014, we probably will be at the 8 billion level or a little higher. So we have taken all of the downturn and move it in the right direction. Then the final point I want to make is what I like the best, which is really long-term fundamentals. What is this area all about? And you know it. I mean, you got close to 9 million people in the market area here of Lakeland. I-4 is growing, and actually I-4 led the state in employment growth last year, and it's likely to do the same this year in 2014. So a lot of that has to do with the long-term fundamentals of the economy. And one of the things that I like the best is obviously the variety of industries that are coming in, the foreign investment, Amazon distribution, all the other investments that you have announced through the Lakeland Area Chamber and the Economic Development Council. You can see how the fundamentals are very positive relative to the location hub that is the Lakeland area. We also see increasingly diversification. We see high technology. We also see health services, life sciences. Now the not only Southern, but the new Poly will likely to do very well for us here. And so it's really an emerging higher education technology hub of our state. So this suggests that with a positive economic environment like we see in the U.S. and especially here in our state of Florida with an excellent business climate, we're going to do much better this year than last year, and certainly beyond 2014 also, long term. So let me just do a bottom line here, and I'll quote this, but this is kind of summarizing what I'm trying to say, that Florida and Lakeland are likely to expand at a higher rate than the nation this year in 2014, and it's positive for stronger economic activity down the road. So that's one thing in terms of our business climate here and business growth. The I-4 corridor, again, with the tape running here, the I-4 corridor is likely to lead Florida in terms of employment growth and overall activity. And then the final point I want to make is the fact that the outlook, it's pretty positive. The winds from D.C. are not that positive, obviously. They have never been, but we have a highly entrepreneurial economy, and I call it the dysfunctions of Washington, D.C. policymaking, although, again, 2014, because of the midterm, likely to be a truce in the war. we'd like to see the Affordable Care Act certainly is bringing in a lot of uncertainty regarding health care and employment levels and what's going to happen to the hospitals and reimbursement. I hear a lot from the major insurance carriers here in Florida. There's a lot of confusion out there, folks. You all know that. So that's certainly not a positive for us. But we, again, the headwind is there, but the tailwind of an innovation economy and a good business climate in Florida is overtaking all of that. The other thing is the budget issue and fiscal issues will always be there. Brian has a very good point when he said last year, turn off the TV at night, because otherwise you become like the ostrich. You know, you get your head in the sand and you don't do anything. And that's not Lakeland. Obviously, that's not Florida. We don't do that. But overall, certainly the budget issue and the fiscal issues and the 17 trillion plus debt are all there. Easily to be solved if we had the good policies, and we are solving it via the private sector. The private sector is growing in spite of DC. And then financial overregulation, and I'm sure Brian's going to have some thoughts about that, but certainly as a director of a regional bank, I find certainly board of directors, we all kind of look over our shoulder of all the regulations that are coming down the pike or are here, and also the Consumer Protection Agency and everything else. You know, we're becoming more bureaucratic in terms of our financial institutions, crossing our T's, dotting our I's, and everything else. So certainly those are things that are negative, but again, the forces of the private sector, the innovation economy is here. And then finally, something that I like to hear from my colleague from Chicago is the Fed exit strategy. We have created $3.7 trillion in excess reserves of the banking system, what we call the monetary base, and how we taper that slowly and surely without creating a major issue in the economy. That's going to be something that Janet Yellen and the new chairman of the Federal Reserve, as well as FOMC, the Federal Open Market Committee, we have to deal with. So I always say, you know, keep a wary eye on policies from the Fed and policies from Washington, D.C., but they're not going to stop this strong recovery or increasingly stronger recovery that we're having here in the state of Florida. So I always say for 14, happy business hunting. Keeping a cautious eye on the Capitol on the Potomac, and every time I land on the Potomac, we have an apartment there, and I go there often. I think I'm landing in Mars or Venus or something like that, because totally different what our state is all about. So thank you very much. I appreciate it.
Thank you, Tony. That was great. Good morning, everyone. It's a real pleasure to welcome back both of our speakers today, back to sunny Lakeland, warm Lakeland. And I know many here have followed Brian in his career over the years and probably feel that they know him not just as an economist, but as a distinguished professional, but also as a friend. And although you really don't need an introduction, I think it's certainly worth repeating. Brian Westbury is the chief economist at First Trust Advisors in Wheaton, Illinois. He's been a member of the Academic Advisory Council of the Federal Reserve Bank of Chicago. He has served as an economic counsel to both professional, business, and political leaders through the years. The Wall Street Journal and USA Today have ranked him as one of the top forecasters within the nation, and actually Wall Street Journal as #1. He's an author of several books, his latest being It's Not As Bad As You Think. His articles appear in various magazines and newspapers and blogs. He certainly appears regularly on Fox News Network, also Bloomberg, and several other medias, including the Dollars and Cents Show, which we appreciate that. And it really is a pleasure to have him back. I think one of his most unique abilities is to bring some of these really complex issues down to maybe just an anecdote or a story. And I remember vividly in 2009, in the throes of all of this, you stood at this podium and you said, "Dogs bark and banks lend." when we were all thinking that it was over with, the fact that, hey, listen, we're going to get back to the, back to normal, and we're getting there, and that's what we're going to hear about this morning. So, again, it's great to have you here. This is one of almost 200 speaking engagements that Brian will do over the next 12 months, so it's a pleasure. And in his spare time, he's home with his beautiful wife, Brenda, and his two boys, Graham and Kyle. So again, welcome back, Brian.
Well, as all of you know, the feeling's mutual. Thank you, Tim. Thank you, Ira. Laura, Keith, it's great to be with you. And Tony, it's always great to be with you. I feel like we're part of a team now. It's kind of fun. So anyway, it's good morning, everybody. I always look out at this room. I've said this before. I do speak a lot around the country. I don't do a lot of business development or Chamber of Commerce's breakfasts around the country, but I do 3 or 4 a year, and I have for the past 15, 18 years. And this is the best one I have ever spoken at. So I think you guys are unbelievable. The best attended, the nicest people. I mean, everything you want to say. And I said this last night to Ralph, but he must have started working at Allen & Company when he was 4 years old, because if he's worked there 54 years old, you got 50 years under your belt work. That's unbelievable. I know you got 20 more. So anyway, where do we begin? I've started out the last couple of years. Where do we start? Where do we go? There's 62 things going on, and Tony and I would have to spend 10, 15, 20 minutes on each one to deal with it properly, to really dive deep on it. We obviously don't have that time. So he hit the highlights, I'm going to hit the highlights from my point of view, and then we're going to get to your questions, and it's always my favorite part, and so be ready. There's stuff that we won't cover, and there's stuff that you're going to disagree with, and there's, so bring it up. Please bring it up. So where do I begin? I guess what I would begin is that we have been living in the past 5 years with this kind of big bang in our rearview mirror, this North Star, this center of the universe, and we call it the crisis of 2008, 2009. And it seems like everyone manages their life, their investments, their view of the economy, sometimes their business, based on that period of time. It's the Big Bang. It's the center of the universe. And I personally believe that is a big mistake, because that is not when the world began. But the reason that this happens this way is because it was traumatic. It was trauma in the true sense of the word. I love good words. Trauma is one of those good words. And I mean, everybody remembers it. Stocks are going down, bonds are going down, gold's going down, oil's going down, your house is going down, everything is going down. And everyone in this room sat down with their spouse at some time in that winter and said, honey, at least we have each other, all right? and because we got nothing else. And even if we have something else today, we won't tomorrow. And if we turn on the TV, they're telling us we're going to zero. And I believe that what we're suffering today is a case of post-traumatic stress disorder. And I'm not making fun of that. I've never been to war myself. I'm not a psychologist. I don't have a family member that suffers from PTSD, but I'm not making fun of it. That's what the clear point I'm trying to make. But I have a story. Let me tell you this little story about when everybody has whatever. I don't know what you think of PTSD, but I'll tell you what I think of it. And it happened in 1985 on a golf course in Chicago. There's this little golf course called Lakeland. It's 9 holes. It's right on Lake Michigan, right in the city of Chicago, in between Lake Michigan and Lakeshore Drive. It's a crazy place to play golf because 8 and 9 go right down Lakeshore Drive, so their cars going 65 miles an hour, honking at each other. One time I remember this drunk staggering across the road. I thought we were going to see a guy die right in front of us. Big buildings behind us. It's a crazy, crazy place. So we're standing on the 8th tee box. Unbeknownst to me, there's this helicopter coming from behind us down Lakeshore Drive, really low. This was the 80s, so there must have been different rules. It was really low. I didn't know it was coming. Somebody in our foursome thought they were being funny, and they yelled, incoming. just this thwomp, thwomp, thwomp. I mean, this rotors, the noise of the road, the everything. And this guy, that we picked up, so I went with a buddy of mine, we picked up these two other guys, hits the dirt. And I don't mean hits the dirt, he hugged the earth. It was the most visceral reaction I have ever seen out of a human being in my life. And after a couple minutes, he stands up, he dusts himself off, and he picks up his bag and he leaves. He doesn't say a word. I don't remember, I don't know his name, I don't know, it must have been Vietnam, this was 1985, but whatever it was, all of that noise, all of it brought back in his mind war. He thought he was gonna die. And what I'm getting to here is that if you listen, if you kind of look back over this past 5 years and listened to the TV, this is what they were doing all the time. Incoming, incoming, incoming. And everyone, because they lived through that trauma of 08, 09, was ready to hit the dirt, hug the earth. And I think what's happened is some people have made really bad decisions in these past 4.5, 5 years because they haven't been able to see the bigger picture. And so let me just give you a little example. We all have the front row. I mean, there's a lot of business owners in here, entrepreneurs, and we all have a front row seat to this, right? I do TV. There's nothing spectacular about it, but it's just a different front row seat. So I remember in August of 09, sitting in the chair for CNBC, got the earbud in my ear, waiting to go on, and everybody's bearish. So the market's up 35%. I remember Nouriel Roubini. You remember that guy? They had him on just before me. And they're like, what do you think, Nouriel? And he's like, well, this is a dead cat bounce. It cannot last. The world is coming to an end. You know, so the market's up 30% and it'll never last. It's just a dead cat bounce. And they go, well, you're a genius, Nouriel. Thank you for coming on. And now we got Westbury, you know. So they come to me and they go, what do you think? And I'm like, I think the economy's going to be okay. I think the market's cheap. I think we'll be okay. It's nothing to write home about, but the bottom line is we're in recovery. And then they drop the bomb. They're like, but what about Dubai? Now think about that question for a second. I'm like, you mean where it is? Like, is this a geography test? I'm like, no, I knew what they meant. Anybody watching knew what they meant. Dubai was in financial trouble. It was going to be a domino and take down all the other dominoes, right? And I'm like, look, Dubai is tiny. It's really, really small. America is big and strong. I think we'll be okay. And then my time was up. Boom, done. Like a couple months later, they call me back. Mary, my assistant, says, Brian, CNBC wants you on. I'm like, oh, Mary, they're calling back to tell me how right I was about Dubai. I went to the bathroom. I was practicing being humble in the mirror. You know, I was ready for this. And I go on. They don't mention Dubai once, all right? Now, let me just stop there for a second. I want you to think back over this last 4.5, 5 years. How many things have you let the TV anchors scare you about? And then we all know the history, right? The market is up 200% from its bottom on March 9th, 2009, including dividends, today, 200%. And so have they ever gone back and said, well, boy, we were really wrong about Dubai. Let's talk about why we were wrong. No. They just move on to the next thing. So here I am, I'm going on, ready to talk about why Dubai didn't take us out, and I'm like, I think the economy's okay, the market's cheap, and they're like, but what about the BP oil spill? And I'm like, you don't know where that is either? Like, you know, it's like, I'm like, I don't know. I've never been a mile deep in the Gulf. I'm like, you haven't either, you know, but you're talking about it like you have. They're going to plug it. A plumber is working on it right now, all right? And I'm like, and we'll be okay. And this has gone on, like I said, for 5 years. And so the last one, you know, earlier last year, right after I left here, they had me on, the same thing, and they dropped the bomb. What about Cyprus? And I'm like, here we go again. I'm like, it's tiny, it's really, really small, we're strong. And I want to tell you what I actually said on air. I don't know, you probably didn't watch it, but it's like, I actually said this. We did the work. Right here in my office. The economy of Cyprus is exactly the same size as the economy of Green Bay, Wisconsin. I said, I live in Chicago. Most people here could care less if Green Bay were wiped off the face of the earth. I'm like, in fact, most people here would probably be happy, okay? And these TV anchors are like, what? Like, they didn't know what to do. But the bottom, you get what I'm getting to here, is that if you let everybody's yelling of incoming and the sound of, I mean, the odds of that helicopter taking us out on the 8th hole that day were zero. They're absolutely zero. The odds of Dubai, Cyprus, BPO, all these things taking us out, I'm going to tell you, were zero. They were always zero. And the same thing with last year. So you think back, you know, Keith mentions last year, we start with the fiscal cliff, the sequester's going on, the debt ceiling debate, the default talk, which, by the way, I think I said this last year, default was never, ever going to happen. We have $2.8 trillion worth of revenue in taxes this year to the federal government, and we owe $260 billion worth of debt, or interest on the debt. I'm sorry, we won't have a problem paying the interest on our debt, ever. And if the Treasury Secretary chooses not to pay the interest, it's a dereliction of duty. He would be impeached, he'd be thrown out. He has to pay the interest on the debt. So we were never going to default. It was a politically made up story to scare people, especially scare Congress, into spending more. All right, and yet what happened is that everybody believed it. And if you sold when they started using the word default, you missed a monster rally at the end of the year and all-time highs in the stock market. And so I don't know how to say it any different. I've said the same thing for the last 5 years. It's really hard it's easier now for people to believe it because we were 5 years into this and the market's making new highs and now people are starting to get bullish. But it's just the beginning. And I think, by the way, 2014 is going to be a lot like 2013, 12, 11, or 10. There's going to be a lot of people telling you the world's about to come to an end, and it's not. All right, the market's still cheap. So what happens is that people then look at me and they go, all right, Westbury, you've been right, I guess, all right, but you've been lucky. You've been lucky. And you've been right all because of this. This is the Federal Reserve's monetary base. This is Ben Bernanke doing quantitative easing, and I have this cool little tool that I get to use this year. So here's QE1, here's QE2, here's QE3. All right, so the Federal Reserve has bought bonds. Tony talked about this. The balance sheet of the Fed is up to $3.7 trillion. By the way, it started at $800 billion roughly, so they've done about $3 trillion worth of bond purchases. Now, there's a couple of things I want to say about this real briefly. Why did we do this? Why did Ben Bernanke go out and buy $3 trillion worth of bonds, $2.9 trillion worth of bonds, and pump all of that money into our banking system? And I know the simple, short answer is, well, the world was coming to an end, we had to do something, okay? But that's not the real answer. The real answer is that because the economy was declining, and inflation collapsed, in fact, turned into deflation in 08-09. If you look at what the models say about interest rates, when GDP is negative, when inflation is negative, interest rates should be negative too. But we can't have negative interest rates. In fact, there's a model that the Fed uses called the Tiller rule, and it said in the middle of that winter that interest rates should be minus 7%. Would you pay anybody 7% to hold your cash? You know what I would do? I would bury my cash in the ground and stand over it with a shotgun. All right? That's 0% interest. All right? Well, it's my time. But it's the easiest 7% I would ever earn. All right, so the bottom line is you can't go below zero. So what Ben Bernanke said is we have this problem at the central bank. We can only drive interest rates down to zero. We can't drive them negative. So if the economy is collapsing and it calls for negative interest rates, we got to do something. And he gave this famous speech where he said, don't worry, if we ever get to that point, we can just drop money out of helicopters. He really did say that. We call him Helicopter Ben, and that's why. All right. Now, by the way, he's right. They could drop money out of helicopters. But the Fed doesn't do that. What they do instead is they buy bonds, and that's exactly what the Federal Reserve did here. So they go buy bonds, they inject currency into the system. Now, the question is, what happened to this? And by the way, this grew 32% per year in the last 5 years. 32%. Now, I don't know how many of you watch Glenn Beck or you listen to Peter Schiff or Ron Paul or Zero Hedge, the big website out there. But they show this chart. I'll pick on Glenn Beck for a second. He shows this chart, puts it on, and now he's on the web. He used to be on Fox, but he would put this chart up, and he's like, if the Federal Reserve's printing 30% more, this is going to cause hyperinflation. The dollar is going to collapse. The banking system is going to collapse. The Chinese are going to sell all our bonds. And then he starts to weep. And OPEC is going to only press oil in yen and not dollars anymore. We're going to pay more for energy. And then he rolls out the wheelbarrow. You're going to need a wheelbarrow full of cash just to buy a loaf of bread like the Weimar Republic. And you're now weeping, all right? And right when he's got you, right then, they cut to a gold commercial. And so what this is supposed to do is 32% more money. By the way, if that's really what the money supply was growing, we'd have 30% inflation. Okay? But something happened, because last year we only had 1.5% inflation. The year before that it was 1.7. The year before that it was 1.4. So what happened? Why haven't we had 30% inflation? And the answer is really very simple. There's some bankers in this room. If you're a bank and you see your deposits grow and they're coming from the Fed's giving you money, and they want you to lend, basically the Fed, the reason they do is they want you to lend it out, they want you to grow the economy, but the Fed says, this quantitative easing stuff, it's all temporary. It's all temporary. Once the economy gets back on its feet again, we're going to take it away. So if you're not a banker, you're a business person, let's put yourself in the shoes of the banker. The bank, you go into the bank, you say, hey, you got all this cash, I need a loan. I want to open a restaurant. I need tables, chairs, silverware, dishes, ovens, need to paint the place, put in new whatever. And so you borrow $100,000 to open a restaurant, and the bank says, well, you can have this, but if the Fed asks for it back, I'm going to have to call the loan. Are you going to take the loan? Is the banker going to actually make that loan, knowing full well that the Fed might take the money back and they're going to have to pull the loan from you? No. And so what banks did is they said, you know what, Fed, you can give us all the money you want. But since you call it temporary, what we're going to do is we're just going to give it right back to you. And so what's happened is that instead of banks holding 10 cents of every dollar in reserves, they now hold $1 of every dollar in reserves with the money that the Federal Reserve created. And if you look at M2, this is the measure of money that Milton Friedman told us to watch. This is all the deposits in all the banks in all the United States. Okay, what's happened is, and there's this red line here, if you look back, this is 6% growth. That's where we grew from 95 to 2008, and then we started growing 32%. Well, if you look at M2, it grew 6% from 1995 to 2008, and then they started doing QE, and it hasn't grown 32, it's kept growing 6. What banks have done is said, you know what, we'll allow 6% money growth, loan growth, bank size growth, but we're not going to allow 32% growth because the Fed's going to come take this back. And so what I'm getting to here is that even though the Federal Reserve has boosted the monetary base 32% a year, the banking system has not allowed that to enter the economy. And I believe the next time you see your banker, you should thank them. Because what's happened is we have avoided hyperinflation. We have avoided a bubble in the economy. And my belief is that it's not quantitative easing that's driven economic growth or stock prices or anything higher. Now, some people say, well, whoa, wait a minute, Westbury. They're buying all these bonds. And when they buy bonds, when the Federal Reserve buys bonds, that holds down interest rates. And when they hold down interest rates, that means the economy's better, especially in Florida, because people buy more houses, or at least they help the housing market recover. And so let's think about that for a second. If you look at what the Federal Reserve owns today, what they own today, they own 18% of all Treasury debt outstanding. So you know that $17 trillion in Treasury debt that we talk about? They own 18% of it. It's actually about 12 trillion in bonds, but the other 4 trillion is Social Security and other trust funds. But they own 18%. And when you hear that number, let me ask you, did that hit your gut? Like, I can't believe they own 18%. That's more than China owns. That's huge. Well, here's a look at history. This is how much of the Treasury debt the Fed owns. I told you it's 18% right now. Guess what? Back here in 2002, it was 20%. So you want to rethink your thought about them holding interest rates down by buying all Treasury bonds? Because they don't own any more of the Treasury debt today than they did back in 2002, 2001, 2000, 2003, 2004. In fact, they're right around the average. So even though the Fed has bought lots and lots of bonds, the Treasury has issued lots and lots of bonds. And the point I'm getting to is that even though the Fed's a lot bigger and they've done all this quantitative easing, I don't believe it's held interest rates down. I don't believe it's the driving force behind the economy. I don't believe it's the driving force behind stocks. So then what's fascinating about this is that we have all of this fear, all of this trauma, all of this 08-09 as the center of our universe, and economists have piled on in a way. And so what I want to show you here is this. I don't know if you're on Twitter. If you are, I do a lot of tweeting. I love Twitter. I love it. It's like bumper sticker debate, It really makes you think hard about how to form a thought, how to state a thought. But late last year on Twitter and on blogs, they had this thing called the Chart of the Year, and it's going to last for decades into the future. Chart of the Year, maybe forever. It's kind of cool. So tweet your Chart of the Year. Tweet what you think was the Chart of the Year. And the Washington Post and a bunch of people tweeted this Alan Greenspan chart. And so I want to show you this chart because I think it's fascinating. So this is half of his chart. We have the Treasury bond market. There's a 1 year, 2 year, 3 year, 5 year, 10 year, 7 year, 20 year, 30 year. And what he did is he took the 30-year Treasury and the 5-year Treasury and looked at the spread. So remember, the yield curve goes up, right? So you have 1 year paper, 3 year paper, 5 year, 30 year. And the yield curve goes up. So what he did is he took 30 year minus the 5 year. Okay, and then he inverted it, and that's what we're looking at right here. The 30-year is a lot higher than the 5-year. Now, his whole point here is that, hey, if the 5-year yield is really low and the 30-year bond yield is really high and the spread is wider than we have seen in history, what that shows us is that people are very uncertain. They're uncertain about the future, right? I'm scared about the future. So if you make me invest for 30 years, I need a lot higher yield than if you only make me invest for 5 years. With me on this? Okay? So the lower this goes, or the higher the spread goes, the more uncertain people are. And this goes back to 1953. So you can kind of see all of a sudden things broke down here. Look at that. All right? So this is uncertainty. Then this is this chart of the year. He overlays it with this blue line. Now, don't worry about all the dots and diddles, but the bottom line is the blue line is now down here way lower than it has been since 1953. What is the blue line? It's business investment as a share of cash flow. So in other words, if you're investing less of your revenues, of your cash flow, then you must be uncertain too. So what he's showing here is that the market shows uncertainty and businesses are uncertain, and it's this uncertainty that is causing less investment today, and therefore that's why the economy is growing slowly. Okay? So what's fascinating, and I think about this, is that if we think about the world today, we're going to come up with a different answer than Greenspan does. This is his chart of the year. And I want you to think about something for a minute. At its peak, how many stores did Blockbuster have? I know the answer, 9,000. You know how many employees they had? 60,000. Remember, these stores with shelves, videotape, people working and, renting you videotapes. Every time we ever rented one, we returned it late, had to pay a late fee. All right, everything. All right. At Hollywood Video, competitor, 4,700 stores. I couldn't ever find an employment thing, but if you use the same ratio as Blockbuster, it was 33,000 employees. So in order to rent videos, and I know there were some other stores out there, mom and pop, a single store, or maybe a 10-store venture, but those are the two big ones. 93,000 employees across the country, 13,700 stores. Who took them out? So they're both gone. Netflix. Right? How many employees does Netflix have? I asked this question yesterday in a talk. Somebody said 2? No, I'm like, yeah. You know how many employees they have? 2,000. How much real estate do they own? Office building and a few corners of some warehouses with servers stacked in them. So what's interesting here, and let me ask you this final question, is Netflix margins, profit margins, higher than Blockbuster and Hollywood Video? Okay, so they get higher profit margins with less investment. Now you're starting to see what's wrong with Greenspan's chart? And let me go on just a minute. This is a picture of business investment in computers and equipment, okay? So what was this goes back to 1960. I know you can't see all the way in the back, but this peak right here, you know what it was. Y2K, right? And since then, we've fallen from $100 billion investment every year in computers to 80. All right, this is overall dollars of investment. Is this a sign of something bad? I mean, I really want you to think about it. Guess what? If you buy a computer chip today for $100, and you spent 3 years ago, you bought a computer chip for $100, you have a better computer chip today or a worse one? Better, right? In fact, it's twice as fast. It's 6 times as fast as the one 6 years ago. It's 26 times as fast as the one 10 years ago. It's more powerful. It uses less energy. Do you know that an iPad uses $1.36 worth of energy every year? You charge it every other day. That laptop you own, $8.31 in energy, electricity every year. The desktop computer you have, $36 of energy every year. You go to look at big screen TVs, you know, the prices are plummeting, the sizes are getting bigger, and the pictures are getting better. Everything in technology is better and cheaper than it was. And so what's fascinating about this is that we have a way of dealing with this in economics. So if you buy a computer chip for $100 today that is twice as fast as the one you bought 3 years ago for $100, we would argue that inflation adjusted, quality adjusted, you're actually getting twice your money's worth. So this gold line is going to stay the same, but I'm about to add the real inflation adjusted business investment in computers to this chart. And so if you go back to Y2K, we invested $40 billion, and today we're investing $80. So the question is, did we go down 20% or did we go up 100% in business investment? See, Alan Greenspan is applying steel thinking. If you don't build $1 billion steel mill, you're not investing, you're not growing, the economy's not good, no one's certain. In other words, what he would say is that Netflix is not investing enough. They need to double or triple or quadruple their investment so that their profit margins come back down to where Blockbusters were. That makes no sense. Why would they do that? They've already got a 32-foot pipe, and they sell more videos than Blockbuster and Hollywood Video ever combined, and of their 32-foot pipe, they're only using 10 feet of it. Do they need to build a 64-foot pipe, a 128-foot pipe? Maybe they'll need it in 10 years, but they've already built for the next 5. So this idea that somehow we're not investing today, it's absolutely not true. I mean, if you look at our world in energy, when we frack wells now, I mean, do you understand how this works? In the Bakken, the Bakken range is about a 20-foot wide seam of shale. It's 2 miles deep. They hit it 99% of the time. 99% of the wells they drill, they hit. You go back 30, 40 years, 5% of the wells they hit. So would you rather have a time where you're doing a lot of wells and you're not hitting, or fewer wells and you're hitting every time? So what Alan Greenspan is saying, it was better back then when you wasted all that money, when you wasted all that drilling. And I would argue, no. Today we're so much more efficient than we were that we don't have to invest as much to get the same profits. And let me just talk about technology really briefly, and that is fracking. I just touched on it. We've talked about it before. It is the biggest, by far, event of our lifetimes. In the United States today, we pay $3.50 a million cubic feet of natural gas. In Europe, they pay $8.50. In Asia, they pay $15. Tell me where manufacturing's going. I mean, we're 1/3 the cost of energy in the United States versus Europe. We're 1/5 the cost of energy in the United States versus Asia. We're going to be exporting. And oil's going to do the same thing. This is why the whole world's changing. Right now we guard the Strait of Hormuz. In 10 years, we won't care. China will have to guard it. It's going to change the whole world. They may think they're, I don't know if you ever played that game Risk, but you build up your armies and then you attack. Well, they're going to build up their armies and they're going to be taking care of the Middle East because we won't care anymore. And it's the biggest geopolitical event of our lifetimes. 3D printing. Remember dot matrix printers? Remember those things? All right. You might, I don't know, you would never write a letter on one, right? And now we all have laser printers in our house, in our office, and you'd write a letter to anybody on them, okay? Your grandkids are all going to have 3D printers. All of them. Everybody is going to have one in their house. You're going to order something from Amazon, it's going to print. Forget UPS, forget FedEx. I'm not saying we get rid of them, but it's gonna print, and it's gonna change the whole world. We have, we have the cloud, smartphone, tablets, apps. I don't know what your favorite app is. Mine lately is Walgreens, but that's dating myself. You have a prescription you could pick up, so you remember this movie Cannonball Run? Remember that thing? All the ladies know it because Burt Reynolds was in it. But it's like, it was like the guys' movie of the 70s, maybe the ladies too. I heard a lot of ladies. Remember they started at the Red Ball Garage in New York City. They went all the way to LA. They raced. This was just, this wasn't NASCAR's, Formula One race cars. This wasn't any of that stuff. They just raced. And Dom DeLuise and Burt Reynolds and this year, last year, 2013, a guy set a record. It's the all-time record for the Cannonball Run. He drove a little Mercedes, nice little Mercedes, but it wasn't a Formula One race car. He did 99.9 miles an hour all the way across the country, from downtown New York City to the beach in LA. And the way he did it, you should see the cockpit of his car. He had like 2 iPads and 3 iPhones and a CB radio and a radar detector. But his number one most important tool was an app called Trapster. Anybody have that app? I can tell who speeds in here. Trapster, you punch in, or you can talk to it too. You tell it where you see the police officer, the sheriff. Mile marker 22, like CB days, Smokey at mile marker 22. He's got his eyes on, and it's on Trapster. So he knew where all the police, and it has a GPS function. It follows, it knows where your phone is, and you see where all the cops are. 99.9 miles an hour. That's our world. You get little stupid things like the Cannonball Run. The records are going to be broken like crazy because technology is driving the cost down, increasing the information flow up. And so what's happened is that while we sit here and look at a stock market, this is the S&P 500, this gold line that's at an all-time record high, and people are telling me it's all quantitative easing, it's all lucky, and I look at the blue line, which is corporate profits. And back in 1999 in Y2K, we made $600 billion of corporate profits, and this year we will make $1.7 trillion of corporate profits. And we're doing it on less investment because we have higher productivity. Productivity equals profits. And so if you're in a business where, you know, like you think about Blockbuster, it's kind of a sad deal. There's lots of employees that are out, people lost their businesses, all that kind of stuff. But the bottom line is that from a profitability point of view, from an economic point of view, we're better off as a result of this. And so what's fascinating is I believe that Alan Greenspan's using his old steel mindset to make analysis of the economy, and so are a lot of other people. We live in one of the greatest periods of technological revolution we've ever seen, and I've been talking about this since 1999 in a way, all right? 98, 97, and it's still continuing. In fact, it's more powerful today than it's ever been. And that brings me to my next point, and that is, okay, Westbury, if all this stuff is so great, then why are we the plow horse economy? You know, what's going on? And I believe we're the plow horse economy because government's too big. So the blue line here is the size of our government relative to GDP. The gold line is the unemployment rate. So in the 60s and 70s, we had the Great Society, and government grew, and the unemployment rate went up. And then we had a smaller government in the 80s and 90s, Reagan and Clinton, and unemployment came down. And then we elected Bush and Obama, and government went back up. And I know we had the crisis, but the government went back up, and unemployment went back up. And guess what? This is a little-known fact. But we peaked at 25% of GDP in terms of federal government spending, and we are now down to 20.8. Partly it's the sequester, partly it's the end of TARP and the end of the crisis, but the bottom line is that the government has actually shrunk as a share of GDP in the last year. And last year, government spending, federal spending, actually was lower than it was the year before or the year before that. We cut government spending 7% last year. That's pretty amazing. All right, now this year, they just passed $1 trillion budget, but that's discretionary spending, but it's still not above its peak of a few years ago. So what's fascinating about this is that we, I think, have begun to turn the corner. And so the way I think of these things is that America, if you go back to the 50s and 60s, we were rich. I mean, I remember the early 60s. We lived in Gainesville. My dad worked for the university. We got our second car, a Ford Falcon. Like, why? But anyway, no, we got our Ford Falcon. We had a Chevy station wagon with no seat belts and a Ford Falcon. And that we were rich. We were rich. The country was rich. 2 cars were kind of getting, and when we get rich, when America gets rich, we get generous. And so the Great Society, it was a 60-40 thing. It wasn't a 51-49 thing or 50.1, 49.9. It was a 60-40. There were people arguing against it, don't get me wrong, they were right. But the bottom line is that it was a 60-40 thing. And then once we grow government too much, we break it. And that's what happened. We had double-digit inflation, double-digit unemployment, and then America, what do? We fix it. And then we get rich again, and then we get generous, and we break it. And now I think we're in the fix-it mode. I think we're in the fix-it mode. And you'll look at me and you go, well, that's crazy. Obama's a socialist, he's a Marxist, he'll never change, he's gonna grow government. I'm like, you know what, if I would have told you in 1992 that Bill Clinton was gonna sign welfare reform and a capital gains tax cut, you would have laughed at me. But he did. That was right in here. You know, I work for Connie Mack back here. And Bill Clinton signed a welfare reform and a capital gains tax cut. And, I don't know what's going to happen here exactly, who's going to pass what, who's going to sign what. But the bottom line is that I think we're on the way this way. And let me put it to you this way. Why are we? Because we have the evidence in our face. So I want you to take a look at this. This is 1945. I know some of you in the very back can't see these very well, but this black and white photo is of Detroit. Detroit was the king of the world. We had won World War II. Why? Because we could manufacture better than anybody else. It was the pinnacle of the Industrial Revolution. Over here is Hiroshima. All right, you could call this the pit of the Industrial Revolution, right? We invented the atom bomb, and we turned a city into toothpicks, 2 of them actually. And so if you were standing there 70 years ago, and you're looking at Detroit and Hiroshima, and you're trying to say, where are they going to be 70 years from now? You would have said, well, what's good for GM is good for Detroit, what's good for Detroit is good for America, and they're going to be king of the world forever. And Hiroshima, well, nobody can live there for 50,000 years, or whatever the half-life of, plutonium is. And that would have been your forecast. But my favorite economist, Ludwig von Mises, he said the quickest way to destroy a country is not to bomb it, but put in bad policies. Actually, he said rent controls. Well, when you put in rent controls, you don't allow landlords to raise rent. They don't invest in their property, and the property falls apart. And that's what happened to Detroit. Because if you look at Hiroshima, it's got a skyline, the envy of the world. That river that you could see, there it is right there. And Detroit is toothpicks. And I know they have that crazy thing they do on Halloween where they burn houses down, but that's not why it's toothpicks. It was never bombed. It was destroyed from within by policy. And even though nobody's talking about this, we all know it. Right? And what's happening is that we broke it. And now we're in the fix-it mode. And so over the next 5, 10, 15 years, I'm really excited about America because I think we're going to be fixing it. I really do. I think we're going to change. We're going to have entitlement reform that actually works. San Jose and San Diego, of all places, have already voted to cut pensions. Detroit's cutting pensions because they went bankrupt. Other cities are voting to cut pensions, and we're moving in the correct direction, and I think we will continue to. And so that brings me back to just the shorter term, 2014. So here we are. The Federal Reserve is holding interest rates at 0. Forget quantitative easing. I don't care whether they taper, NQE, buy all the bonds back. I don't think it helped the economy when they did it. I don't think it'll hurt the economy when they take it away. That's why I showed you those 2 charts, monetary base and M2. But the Fed is holding rates at 0, and that alone means they're easy. They're not in the way of growth. All right? And so that's number 1. Number 2, the federal government is not getting any bigger right now. I mean, I know Obamacare's there, I know all these things, but the bottom line is that the size of the government is sliding slowly as a share of GDP. We're a long way from going back to where we were in 1999 or 1964. But the bottom line is it's still sliding. I think we're moving in the right direction. And the final thing is that technology is booming. It's just booming. And we live in one of the greatest ages ever. And when I put those 3 things together, last year we grew about 2.5% GDP. This year I think we're going to grow 3%. The stock market today is 22% undervalued. That's not as undervalued as it was at the beginning of last year, but it's still undervalued. And for the sake of the tape, my S&P 500 forecast for this year is 2,150. My Dow Jones forecast for the end of this year is 19,500. All right? And by the way, if all that happens, we're still under fair value. A little bit. We're a lot closer to fair value. But the bottom line is, from my perspective, is that the upside is just the same as we saw back in 10, 11, 12, and 13, and that everybody's going to be scared of a lot of things, but all the systems are in place for us to keep growing, for profits to keep growing, and for the stock market to keep going up. Thank you very much.
That was great. Thank you. Thank you both. We have time for a few questions. We've got microphones on both sides, and if you have a question, please raise your hand, and they'll get the mic to you. And if I could ask for these front lights to maybe be dimmed a bit. We can't see out there in the audience as to who is raising their hands.
All right, who's got a question?
Yeah, who's got a question here? How about on the front row?
Silence.
We're not seeing any questions. Okay. Here we go.
What do you think about the Jobs Act and its effect on our economy? Is it more important that larger private companies are going to still drive the growth, or do you think startups really have a place?
Can you explain to me the Jobs Act? I'm, yeah.
The Obama passed it recently in April, and essentially it says that crowdfunding can occur legally now, not like pre-sales of products, but actually individuals to invest in companies. So if you, everywhere from $2,500 up to $100,000.
I find that fascinating. They call that the Jobs Act. They should have called it the Jobs, the BP oil spill, Hurricane Katrina Emergency Creation of Growth Act. You know, crowdfunding is great. I remember that. I don't remember it being called the Jobs Act. Maybe that is what they called it, but that's politicians for you. We should have investment, and crowdfunding is great. It's awesome. Let people do it. What's interesting about this is that the SEC regulates like crazy. Mutual funds, ETFs, hedge funds, all of these things are massively regulated because you know, what people say is, well, Wall Street is evil and government has to take, you know, control of them. Well, you know, I sure hope that the people that are trying to raise funding to open new businesses are on the up and up. And that just works. So before you go dumping money on the internet into some kind of crowdfunding scheme, do your due diligence. There's a lot of private equity. There's a lot of venture capital around. If you're really interested in it, you can work with people that really know what they're doing. And that doesn't mean just answering some ad with somebody with a good idea on the internet. So be careful out there. I find here's the funny thing about this, and that is that the government will call it the Jobs Act, and all they let you do was do what you want with your money. I find that, I mean, I'm more interested in the name of the thing than I am about the idea. It's like, it's hilarious. Now the government's going to let you create jobs with your money, and they're going to take credit for it. It's like hilarious. Yeah.
Okay. All right. If you have a question, please raise your hand. We've got one over here.
I happen to agree with you on the point that you made about productivity and when you use the example for Netflix versus Blockbuster. And you made a statement that higher profit due to productivity was a good thing for the economy. And you did mention that, you know, it's sad that people lost their jobs, but I think back at Robert Reich would have had a heart attack, you know, because he argues that wage growth and the value of the economy is people having jobs. So I wonder, which way do you think, my question goes, which voice is most of the people in America listening to in regards, especially policymakers in Washington?
Yeah. So I think I've said this one before. It's my favorite parable of the economy. I'm going to go back to it because we're back there again. By the way, I mean, I've been doing this for 32 years. Tony, you're probably 35 or 30, you know. No, you're 31.9. But all these arguments, they come around all the time, and mainly because they're political. So if you go back to the 1800s in England, there was a guy named Ned Ludd, and he claimed that the looms were stealing jobs from people and wrecking the economy. He was the Robert Reich of his day, and he formed the Luddites, and they went and burned down factories because they were stealing jobs. And so this is not a new argument, all right? Nothing's new about it. So let me give you the way I think about it, and I'm sorry this is going to take like 2.5 minutes here. But my favorite parable about the economy is that imagine we live on an island. There's 10 people, and each of us fish every day. We catch 2 fish, and we eat them, and we go to bed. It's subsistence living. So 10 people, 2 fish a day, GDP is 20 fish a day. And let's say that 2 of those people, 2 of our fellow islanders, figure out how to make a boat and a net. And they now go 200 yards offshore, and they catch 20 fish, just the 2 of them, throwing their net out. And they come back in, and their boat is filled with fish. They catch as many fish as it took 10 of us to catch yesterday. all right? So productivity, they're Netflix. Productivity has gone through the roof. Now we only need 2 people to fish instead of 10. So what do? All right, so those other 8 people, they could say, if it was me, if I was one of them, I'd be like, thank goodness, I hate fishing, all right? But I'm gonna grow corn and make cornbread. I'm gonna go pick coconuts and trade them for the fish. I'm gonna fix their net if it gets torn. I'm gonna clean the fish and cook them and open a restaurant. And then what happens is if everybody starts to work to earn their 2 fish but now they have to buy them from the other people, guess what? When we sit down to dinner, we have 2 fish, a piece of cornbread, and a half a coconut. And we didn't have to cook our fish either. All right? And so we're better off. Wealth, we now have Thanksgiving, plenty. It's unbelievable. Or we could say, well, this just isn't fair. Those 2 are rich, we're poor. And the 8 people could vote to tax them 80% and redistribute it. And then if they do that, then everybody still only has 2 fish. And so we have this great new technology, but 8 people are unemployed and living on the dole, and we only have 2 fish each. So our living standards aren't higher, and unemployment is higher, and government is bigger. And so what I would argue is that the reason we haven't seen the real benefits, the full benefits of Netflix and apps and the cloud and smartphone is because government is robbing us of the benefits. And so that's why we have 6.7% unemployment and the greatest productivity the world's ever seen. And so and what government will do is they'll raise the size of government, steal our profits, steal our growth, steal our jobs, and then claim that it's the private sector that's doing it. It's not. It's the government that's doing it. And so I don't know how we ever fix that. Maybe de Tocqueville was right. Maybe Jefferson is right. Once you get to that tipping point, you never come back. I don't know. But that's.
I think right. We don't listen to Robert Reich here in Florida, that's for sure. But and amen to that. When 2 economists agree like that, that's the bottom line. I mean, that's the reason why we're underachieving relative to employment growth, and unemployment is still relatively high. Is the break of government and innovation and entrepreneurship and job creation.
Okay, got a question back there.
Hello. I had a question concerning the PowerPoint presentation you were given where you were doing the writing
Sure.
on it.
Uh-huh.
And what kind of device were you using?
I stole it from John Madden. No, you know what? I think
Illustrator.
you know what? Come up afterwards, and I will get your name, and I will promise that my tech guy will tell you what we're using. I don't even know what it is. We've been using it for a while. It's really cool, isn't it? I love it.
Okay. Other questions? Okay. All
right, come on.
Going. Here we go. Okay.
I'm Mike Howell, and I'm 73 years old and retired, and I work about as many hours doing volunteer work in the public schools in Polk County. And I'm just wondering, because I'm not smart enough to figure it out myself, but how can we, in what anybody would consider a reasonable period of time, create the kind of jobs to deal with the fact that a lot of what we're turning out in our schools are not qualified for the type of jobs that are currently available? And what do we do in the meantime with that?
Yeah, sure.
Not the academic, recovering academic, but I think you're a very good point. I think one of the key issues that we face fundamentally, structurally, is the output in our high schools and the output in our universities relative to the jobs that are there. I think the emphasis has to be, and the state of Florida now has become a leader in this area, is charter schools, academies, vocational training, our community colleges. You have an excellent one here, a state college that is excellent here in Polk County, in terms of the training of the labor force. And I'm not talking about just specific skills, but mathematics, critical thinking, all the things that go on in terms of being able to adapt and innovate in this kind of rapidly changing technology and global economy that we have. So like we used to say in 1960s football at LSU, 3 yards and a cloud of dust, give it to the fullback. But that was, in other words, just keep pushing academies and innovation in our high schools.
Can I get my charts back up real quick? I want to look at two quick things here that have to do with this. I want you to, this is government spending as a percent of GDP for France, Germany, Greece, Italy, Spain, and the United Kingdom. Okay? So there's a couple of things that I would point out. Number one is during the crisis, remember Rahm Emanuel is my Chicago mayor. He's got that famous line, "Don't let a crisis go to waste," right? Every government increased their spending all over the world, every single one, okay? And what I find now some people would say, well, they had to because the crisis was here. But at the very top up here is France. France boosted their spending and they have not cut anything. Let's take a look at Greece. Here's Greece. They boosted their spending. They went bankrupt in about here. Government spending went down a little, but basically they are flat. They have not done austerity. Okay, now there's a reason that I bring this up. Because if you look at the red line, and I know it's hard to see it in there, but we'll go back and do it. In 2005, Greece spent 46% of GDP. Germany spent 46% of GDP. Today they're spending 44%. They've actually cut government spending since 2005. Now, you know what's fascinating? Germany has a 5.5% unemployment rate. You know what Greece's is? 24%. So Greece hasn't cut their spending, Germany has. And Germany has a lower unemployment rate. Now look at 31 countries around the world. This is higher unemployment, this is lower unemployment. This is bigger government, this is smaller government. And so over here are countries that cut the size of their government, Poland, Germany, Israel, and they all have a lower unemployment rate in the last 8 years. All of these countries boosted, there's the United States right there, boosted their spending and they have higher unemployment. And this little gold line, I just had a computer fit it. Said, what's the trend? Here's all the dots, tell me the trend. Bigger government, higher unemployment, smaller government, lower unemployment. If it goes back to over here, Keynesianism has sold us a bill of goods that somehow the government can spend money and create wealth. And it's not true. It's never been true. And there's people suffering all over the world because of this. And I like your question, it's absolutely right. How do we educate people? I couldn't agree more that that's important. But the reason we don't have jobs is not because people aren't educated. It's because the jobs don't exist because government has literally robbed them from us. And so, and by the way, if you can't get a job, why would you go to school? It's a sacrifice to go to school. It's a sacrifice to care when you're at school. And if there's no benefit for going to school or caring when you're at school, no wonder people don't get educated. And so that's when I think partly, I'm going to just get on my high horse here for a second, we try to make school fun. And we try to make school more interesting, and we try to make school more, like a party, or like I know I'm going off on my high horse, but it's like, I want my kids, I have an 11-year-old and a 9-year-old, I want them to learn math, reading, writing, science, social studies. That's what I want them to learn. I don't want them to learn how to recycle and reuse and all this other stuff. I want them to learn how to do math and read and write. That's what I want them to learn, and we've turned all of this stuff upside down. And I'm not running for office, I'm not asking you for vote, I just lost 20 votes, you know? But it's like, the whole point I'm getting to is that we keep focusing on these, and your question is important, I'm not putting down your question, but when we focus on, we're not, the way to solve poverty in Africa is not to forgive their debts, is to get lower taxes, free markets, private property, the rule of law. That's the way you solve poverty. And yet what we want to do is go educate people and give them debt, you know, cut their debts, and that's not the way you get growth. You get growth by creating an environment where people, entrepreneurs, can invent, innovate, create, and serve other people. That's what we're put here for, to serve other people, and you do that best by working hard and innovating. Netflix did it. They should profit from it, all right? And so that's, you can see it around the world. It's as clear as it's ever been. And yet it seems like sometimes that we're further away from understanding it than we've ever been. So, sorry. I got on my high horse there.
That's great, thank you. Again, Tony, Brian, thank you so much for another wonderful year. We will make these charts and that available. Contact us at Allen & Company, or certainly go to our website, alleninvestments.com. Again, I want to thank Kathleen and her staff at the Chamber. We'd like to thank the Lakeland Center, certainly all of our colleagues at Allen & Company, and most of all, we thank you for your time and being with us this morning. Again, have a good day and a great 2014.